Kovacevich, until 2010, was the chairman and CEO of Wells Fargo, an institution that has survived the U.S. crisis and, in fact, become stronger as a result of acquisitions made in that period, and has become one of the strongest institutions in the world. So we're very pleased to be able to speak with you today. Dick, tell us, what is it about Wells Fargo that made it able to survive the U.S. crisis, and what were the disciplines in place that enabled it not to make the mistakes that many of the other U.S. institutions did?
Well, I think one of our greatest strengths over the past 25 years has been our risk management. We have done a great job of that. We've avoided many crises in the past, and we basically avoided this crisis as well. Even though we were a leading mortgage company, we did not participate in the origination of subprime mortgages, exotic subprime mortgages that turned out to be a very high risk, which we knew they would,
right.
that would result
and
in.
When did this frenzy for originating subprime mortgages, when did it actually start in the U.S.?
Well, I would say that the level of subprime, there's always been some subprime mortgages, and it was well less than 10% of all originated mortgages, and they've been around for a long time. But what happened is, beginning in, let's say 2005 or so, the percentage of originated mortgages of the subprime level went up to 50% of the market, a huge increase. And these were not just ordinary subprime mortgages. The risk were amplified because there was negative amortization of these mortgages, stated income, no doc or low doc documentation of the mortgages. It was kind of almost an invitation for fraud. And we recognized this as these products were being created and decided that it would be totally inappropriate for our customers. And even though we could have originated these loans and sold them to the marketplace, it would not be consistent with our ethics and our values.
Yeah, and during that period, everybody else was growing their market share, and I figured that Wells Fargo would have been losing market share. You would have been slipping. So how do you keep morale during that period when you were counterintuitive, or rather intuitively in the other side of the...
Well, yeah, in fact, we were, prior to the crisis, we were the leading number one in the market, 15% market share. And in those 3 years of the exotic originations, we lost 4 percentage points, $160 billion of originations each year. And we're no longer the leader. But again, our views, because we've been through these processes before, is that if it's the wrong thing to do, and if it turns out that you were right not to do the wrong things, you will be rewarded in the future. So yes, it was painful for a while, but since we've, again, had this discipline in the past, our people do know that we will gain the advantage in the future if indeed it blows up, and of course it did. And so what happened is we went from 15% market share in the 2005 period, and in 2006, 7, and 8 we went down to 11%. Today our market share in mortgages is 33%, and we would never have been able to triple or double, depending where you want to start, our mortgage market share if we had not avoided the problems and then taken advantage of the situation once the people who did these mortgages left the market.
So in your more than 30 years of experience in financial services, you've probably seen this several times before.
Exactly.
And so you've sort of internalized the discipline required. How does someone in your position internalize the instinct for this? What is your view of financial services? What is the one thing you should put your finger on so that you don't lose perspective?
Well, doing the right thing is the right thing to do. I mean, it's as simple as that. If you really know when risk is exceeding any kind of a normal level, and you have to have the discipline to say, this is risk that we should not take. We're not getting paid for it. It's wrong for our stockholders and for our company, and it's wrong for the borrower. And what surprises me is how many people fail to see this. Because the risk taken in this subprime mortgage was the most excessive I've ever seen, and what people don't quite understand, there were only about 20 institutions who did most of this damage, and most all of them were not. In fact, there's only one commercial bank that was really part of the 20. All the rest were investment banks, which were securitizing and selling these mortgages, and most all the originators were either non-banks, like a Countrywide, or they were S&Ls.
Right.
What's shocking is that 8,000 commercial banks today are being vilified and are having additional regulation put on them, and only one of the 8,000 were actually a commercial bank, and the rest weren't even commercial banks, and yet we're being punished.
Right. Now, going forward, right through the 2000s, the last 10 years, the investment banks had introduced this, get it off your books, have it as a traded asset. They've also been, taking on the liability side of the business and making investments and so on for commercial banks. And the Volcker rule coming in place is trying to, to sort of put fences around that. The days of great profitability is over in financial services, you think?
Well, I think that the increase in regulatory costs, many of which were not the cause of the crisis and will not avoid the next crisis, has reduced the profitability. I think that over time, and it might take as much as 5 years, people will realize that these additional costs are not making the industry safer. They are increasing the costs, because increasing costs to the banks, they in turn are charging their customers more. And we've already seen that with increases in fees. And I think it's quite likely that some of these excessive regulations that are not necessary for protection of the taxpayer or to reduce the probability of having another crisis will be eliminated. What does reducing debit card fees have to do with this crisis? It's more of anger and punishment with the thought that, again, the banks caused this problem. It really wasn't commercial banks. It was investment banks and S&Ls. And yet we're all being punished as if we were guilty when most of us, the vast majority, didn't even participate in this issue.
And right through your career, because of regulation, you've seen non-bank financial institutions come in, almost as a shadow player and taking some market share. Right through the 2000s, you had Countrywide, calling the bluff of, the mainline banks like yours. And in the 1990s was the monoliners and so on. Do you think that all of this regulation is going to create, substitutes which are not financial institutions taking on specific business lines and getting around the regulation?
Absolutely, and that's what happened in the past and it's happened in the future. Let's take proprietary trading. There is no indication to me that proprietary trading had anything to do with this crisis. So it's trying to be eliminated, but people are going to do proprietary trading, and it will go outside the banking system and could well cause another crisis, and then it'll be blamed upon banks again. So the S&Ls could only get big as they did and do these originations because their regulator was not as involved as the OCC to see the risks that were being taken. Investment banks got big because commercial banks for a while weren't allowed to be in their business. And quite frankly, if we would have eliminated Glass-Steagall 40 years ago, we wouldn't have had this crisis. And people think that the elimination of Glass-Steagall caused this problem. It's just the opposite of that, is that these banks, investment banks, could not have got as big as they did if they weren't protected by Glass-Steagall. And even Barney Frank has said, and I don't often agree with Barney Frank, but he said that if the insured depositor institutions were the only ones that were in this business, this crisis never would have occurred. And he's absolutely right.
But with interest rates continuing to be low and access to credit, being very open because, there's so much liquidity in the marketplace, that risk continues. Would you say that?
Well, yes and no. I want to repeat. of the 8,000 banks out there, only one of these caused this problem. So why should it be any different in the future? Right? I think people are missing the fact that the vast majority of all insured depositor institutions behaved appropriately. And so if they behaved appropriately in the midst of this big bubble where you could have made a lot of money for a while, right? Because
it is a disciplined industry.
I think they did a much better job, and that's not coming out anywhere.